No, no worries, no worries. I also went out of Discord too. So anyway, we're looking at the Martingale Principle, and the question was, can you use how do you use take profit targets within utilizing the Martingale Principle? And really, it doesn't really affect it in any way. Um, right here, here's a price distinction within the greater price swing. So you have um, we have this swing that I identified, this low being significant because whether you identify it as this low or this low, it doesn't really matter. This is the FOMC meeting. The low set in, right? So volatility condenses. Jerome Powell says what he's going to say, and then you get a little bit of a low time frame uptrend. I, I'm just anchoring my idea on the swing within there, and then you look into these smaller swings, and you kind of see different smaller time frame price distinctions within the 4 hour chart. So if you go down here, you can see that there's that was the idea we were looking at the 4 hour, but within there's this swing, that swing, and then there's this swing here. This one is very cut and dry, right? It's like very obvious, so we can use that one. Maybe I don't know exactly how you define a point of release trade, but it looks like this could be that, right? Because price starts moving aggressively and price returns to that level right there.
Yeah, exactly.
Yeah. So and then it does offer a response, right? So price hits that level, and one of the nice things about trading point of release is that in my opinion, it tends to play out pretty quickly, and that's what you see here, right? Price comes down, and then almost immediately, starts reacting to the upside, and and then enters a little bit of a consolidation here. But so as far as like where your take profit is set, it doesn't really affect Martingale at all. Because I would argue just you want to use multiple take profits just because you want to capture more of the move and leave yourself more open to a move like this, right? So if you have one take profit, there's just no way to capture that, right? Because you know so if you were to identify go down on a smaller, we're on the hourly, but if you went in even smaller time frame, right, you have this low time frame downtrend, right? And price, if you went to say let's go to a 5 minute chart. Well, you get the idea. Basically, a low time frame downtrend, and you get what I look at is a market structure shift, right? So price kind of in order to reach that point of release, price has to create a downtrend on even a small time frame, and then once it starts breaking that back to the upside, that's when you start to get your market structure shift. So going back to what we were talking about earlier, like if you take one take profit, like where do you put it? Do you, I mean, do you take it here expecting it to move lower, or do you not take it there and expect it to move above the highs? I mean, there's really, both are valid, but both are also not, you know, they don't capture all the possibilities that exist in the market, right? It could do either. Price could come up, and then a lot of times when the point of release fails, you still get a reaction, right? So like say hypothetically in a different world, this played out differently, right? It did.
Also, can I ask you a question?
Yeah, yeah.
Uh, in an uptrend, when do you start your martingale entries? Is it on the mitigation of an order block or on the clear breaking point?
Okay, yeah. So I think what you guys are getting a little confused because martingale doesn't have to do with the entry, right? It doesn't affect entry or take profit or exit on a trade. It just simply affects the risk that you're contributing to a trade. So, you know, say you have a risk, everybody has a different risk model. A lot of times people use the term 2%, right? They're just risking 2% on a trade or something like that. Um, the one I use
That
is,
thing is very common in gambling.
in
It's an actual strategy. So yeah, they'll risk double if they lose double, double, double.
yeah, that's the idea. And the funny thing is, it's a concept that I would think about as a kid. I would like think about the concept because I used to gamble as a kid, and I remember like with just other kids, and like when I was really young, even. And I remember thinking about the concept, but I had no way to conceptualize it or make it scientific in any way. But it was something I had been thinking about for a long time, and it's a good example of like how whatever methodology you choose, it wants to be tailored to an individual, right? So for me, this methodology is kind of something that is almost part of my personality in a way. So it works very well for me. But yeah, going back to what we were talking about, like the Martingale principle doesn't have anything to do with entries. It just what it is if we go back to that larger swing, is you're anchoring smaller time frame trade ideas within a larger time frame. So we've got this swing here to this swing here, and so Night King, let me ask you a question. What would have to happen in price for you to say that that price has topped out here, or at least created an apex high, so to speak, and then is going to probably reach lower within the swing? Like, what would you look for? What area would you look for?
Judging on the last impulse move, I'm eyeballing it at about 4,100. Sorry, 4,200. Yeah, about there.
So these lows here. Okay.
Sorry, a bit higher. A bit higher.
Here?
A bit higher, a bit higher. Next one.
Here?
Yeah, thereabouts.
Okay.
If the price violated that to me means that like the trend on this time frame is changing, which is that's the 1 hour. So yeah, if we're judging 1 hour.
Yeah, no, I agree with you. I would actually use that low as well. I'm just trying to walk you through the process of the martingale. So then say that did happen and you did get this invalidation, and then you're looking at that and you're saying, okay, well, now price is going to kind of make its way lower and look for liquidity lower in the market. Then you know say you're on a 2 hour chart, and where do you think price would bounce after taking out this level here? Like if you were in a you know in a short position or whatever, just looking for price to take out this level and then move lower, where is the next price distinction that you'd be looking at for price to bounce from that move?
I would look at right there, 41.3. Personally, that's the first area I see.
Okay.
That's the spot for, yeah, 41.3. I
Y-
agree.
yep. Okay. So 41.3. But essentially, you'd be using this low. Maybe you're using this low, but roughly these lows here as an invalidation to maybe an entry up here or something like that.
Yeah, correct.
Yeah.
The
Okay.
last low before the breakup structure on that 41.2 thereabouts, or 40.9 or something. Yeah, thereabouts. That low, somewhere there.
Okay. And then if that low, got violated, then you would be expecting price to maybe move down to this level here or into this region and bounce there. And then you could use this.
Probably in the middle of that 3,900 consolidation area, give or
Yeah,
take,
39,
just in the middle of that.
39.6 was where my eyes went to,
Okay.
which just seemed like more interest.
Yeah, no,
I
that's
may be wrong.
no, that's a
So
pretty.
it's a basic consolidation, so thereabouts, about 39.6.
Yeah.
It's a pretty obvious level right there, right? Maybe you're using this level here. Yeah. So not a huge distance, but maybe it offers a little bit of reaction. But yeah, general idea is good. So what we've done essentially is we've taken this greater trade idea, right? So maybe we go on a daily to reframe it. So maybe like me personally, I took this long position with a macro rooted in a macro bias. So I'm thinking, that this is a macro thing at a macro level, and it's been consolidating for months. I'm looking for a high time frame move, right, up much higher, just to just to a little teaser, I would be looking at roughly this level or that point of release up there. But anyway, that's not really the point of this video. The idea is that we identified this idea, this swing here, and we broke it down into 3 subcomponents. And these 3 subcomponents are really important when you're using the Martingale principle because you have your different invalidation levels, right? So now you've taken a trade idea, right, that was previously anchored on this low here, and as it's moved higher, you've broken it down into subcomponents, and this is really critical. You can't utilize Martingale without doing this. And so what you're doing is you've broken this into different swings, right? So now I can go down a 15-minute chart. I have this 15-minute swing, and then if I go to a 2-hour chart, then I have this swing, and again go back to the 4-hour chart, the larger swing. And the idea is that you're trading this swing. You come down here. So personally, like when I would enter a trade on my live account, not my testnet account, but if I were entering a trade at this area, this high up on the trade, this extended on a 15-minute chart, I would be entering, or just any initial trade really, I would be entering with 0.15% risk, which is much lower than what a lot of people use. Again, this would be on my live account, not my trading account. And sorry, my live account, not the this demo account. So 0.15, but we can just use the 0.5 just for ease of reference. So say it's 0.5.
Would that be based on your 1% capital allocation? 0.15.
Yes. Yeah. So this is another very important thing when you're talking about the Martingale principle is, people think it's doubling down on a losing trade, but it's not. It is doubling risk based on certain parameters. And it probably would be helpful if you're doubling risk to maybe lower your initial risk position. So you've broken the swing down into different subcomponents. And now maybe, you lower the risk, right? So maybe if say you're just trading with a 1% static risk model, right? Where you just, no matter what, you're just entering with 1% on each trade. Well, if you're going to incorporate the Martingale principle, it would help to lower that risk considerably so that you can have room to double it, right? That's what you want to do. You want to give yourself room to double risk without violating your risk model. So essentially, if I start at like 0.15%, and then price moves. So essentially, we'll just walk through it. But yeah, say I identify this price distinction, I enter a trade here that constitutes, if it hit here and just went straight through to the invalidation, that would take 0.15% of my account equity from me. But then, I've identified but then it moves into this, we identified the greater swing, right, on the 2-hour chart. So maybe it does that. I lose 0.15% of my account. But now when price comes down to this distinction that, we identified, now I'm using double risk here than I did on this trade up here. So now instead of 0.15%, I'm entering with 0.3%. So if price hits that level and just nukes, shits the bed, and goes right for my low or my where I would have my stop, then I lose 0.3% out of my account. And again, just to play it out for the sake of being thorough, then we identified an area down here. After price hits this level, then we would double it again for a third time, and then maybe you would be entering using 0.6% risk. That number isn't exactly important. It's just what's important is to understand the interval, right? So it's 0.15, 0.3, 0.6, doubling as price nears the ultimate invalidation that we're kind of framing it or breaking it, the subcomponents from, essentially. And that's really Martingale. I mean, there's really not much more to it. that's that.
But my second question would be, obviously we're doing the scaling of entries based on an idea that it's going to go upwards in an uptrend. But my question would be, we know that in a higher time frame analysis, it's not in an uptrend yet. So would it be more prudent to wait for the higher time frame to shift to an uptrend before we start the martingale scaling in on entries?
Yeah, I mean, if based on your macro analysis. So me personally, I'm, looking at it from a frame that we are in a macro uptrend. So I understand people might, disagree with that. And if you do disagree with that, then you should trade according to your macro bias. But me personally, it's just the way I'm looking at it is, kind of looking at the monthly, right? If you take the monthly, right, there's no downtrend. So that's kind of the swing I'm looking at on the monthly.
Cool.
But yeah, in the situation where there was major headwinds against you on the macro, then yeah, you know, uh, you might want to stand out of the way of that trade. It's always good, because like if you like when volatility compresses like that. But I also think this is a very good time to take a trade, right? Because when volatility starts compressing, it gives you very tight risk management parameters, right? In the sense that like when I took this trade here, right, I took this trade like really right as volatility started unwinding. I mean, you can see here, it kind of, it's like, look at this. It starts like coiling up in this super tight range and then, expands, then, gets aggressively more so. But that was like the peak of compression right there. And I took my entry, based on that, and it, violated these. It just starts turning around a little bit, and I took that, and so from that position, it's price doesn't have to go very far to invalidate my idea, and I get an entry to a macro trade. But if you wait until after volatility expands, then it's much harder to your invalidation levels are much further away from price just because volatility is expanded, right? So like if hypothetically if price just kind of hit the gas and went pretty parabolic from here, running up to kind of the level I'm interested in, like in one go, right? Like your previous low would be right here, right? I mean it's just a long distance to your invalidation, essentially. If you were formulating a long idea, again, that probably doesn't answer your question, but I think you had a really good point that like if you do identify that the macro is against you, then that's probably a good contra trade indicator, and you don't want to take that trade. Anyway, I'm gonna put a pin in this video and